Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi, and in today's episode we take a general look at the markets and some of the highlights that we've seen so far as quarterly and year-end results have come out from many companies listed here on the South African JSE as well as internationally too. My guests in studio today are Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nesan Nair, who is the Senior Portfolio Manager at Sasfin Securities. Gentlemen, great to have you both with us on the show. I'm actually looking forward to today's discussion because, geesh, if you take a look at what we've seen coming out of the US versus South African equities and the pressures on emerging markets, it's been a very, very mixed bag, not only of performance, but of economic news flow too. But let's start off with the generic theme that we see from a global point of view. Clearly, a lot more optimism when it comes to developed markets, and it seems like Trump is actually doing good for the US here, Andrew.
Yeah, the markets seem to like Trump. I think, we're living in very interesting times when you compare developed markets versus emerging markets. It's almost a tale of two worlds at the moment. There's a risk of no one likes emerging markets at the moment, and if you just look what they've done year to date, I think they're down about 11-12%. And the US market's up, I think, almost 10% year to date. So it's very, very different markets. And when you look at what's been happening in the US, you talk about Trump. The US is now reaching almost their longest economic recovery on record, or cycle on record. This will be 10 years next year. I don't think they fall over before then. And Trump will stand up and say this is all because of him. He's probably inherited a lot of it, but the thinking around let's try and make America great again, I think is rather let's try and keep America great, because they've done a fantastic job. And if you look at their markets, all-time highs, look at the economic data coming out, unemployment, all-time lows. They've grown, non-farm payrolls for 96 consecutive months. This is all-time record. So everything is good in the US. Europe is a bit of a mixed bag. I'm sure we can touch on that as well. And then you come to emerging markets, South Africa, it's the brats, Brazil, Russia, Argentina, Turkey, South Africa, that are really under pressure at the moment. So, from an investment point of view, maybe the opportunity lies in the emerging markets, but everyone's sentiment sits with the developed markets. So it's a time to, I suppose, really test investors' resolve. Are you going to do what you should do, and be greedy when others are fearful?
And isn't that the question, right? Because so often when we see these bull markets and this rally so strong and so significant, we often want to get in and feel like we don't want to lose out on any more potential that might still be there. Is that the sentiment that you often feel from clients at the moment, Nesan, that look, the US equities have been on a bull market and rally, we want in, or should we be looking elsewhere?
Listen, they have a term for that. It's called FOMO, right? Yes. Fear of missing out. So, psychologists have even defined this. What we're seeing is that the US markets are really the only markets that are growing globally. Europe is still negative for the year. Most of the emerging markets are negative. Hong Kong, China are negative, deeply negative. And Japan is obviously, following the US, slightly positive, but not as good. The S&P is up 10%. The Nasdaq is up 14-15%. These are clear leaders. I think there is an element of fear of missing out, sure, but the fundamentals are justifying continued investment in the US. The economic growth in the US is, last two prints have been over 4% for a developed market, the biggest market in the world. That's phenomenal. China is coming back, and so a lot of money that was invested in China by international investors, obviously moving towards developed markets now. There's still a fair amount of stimulus through tax cuts that are coming through, the benefits of that are coming through the US. The rest of the world is in austerity mode, right? Including ourselves here with higher taxes here, whereas in the US they're cutting taxes. So I think fundamentally one could still justify an investment in the US. The momentum is still very much there. The earnings are very positive coming out of the US. S&P earnings are growing 20%. Here, if you look at the companies that have come out, everybody points to a very weak outlook. So, I think if you don't have a portion of your funds invested in the US markets right now, you'd be missing out on the growth there.
Yeah. Talk to us though about Europe. Andrew did touch on the fact that it's quite a mixed bag, and it's been interesting observing that region for the last 5 years, whether it be the pressures of Italy, Spain, the UK, Greece as well, and even France. But of course, political influences have also shaped the dynamics there. Are you still seeing some sweet spots perhaps in Europe?
I think in Europe it's still very much an old economy Europe, very industrialized companies. And in the US it's very different. It's technology. The Nasdaq is really leading these gains that we're seeing in the US markets. And apart from the oil industry, for example, which is a function of the underlying oil price, some of the higher tech industrials in Europe, if you look at the big consumer multinationals like the Unilevers and Nestle's, of the world, they haven't really, grown strongly in the recent past. So I think Europe will have to, take some time, to resolve the Brexit issue and the issues in Italy. It's still very much, from an investment perspective, there's still elements of risk there that, people are not really comfortable with. And the growing sectors globally is being led by technology, and all the big technology companies in the US.
Andrew, any thoughts on what Nesan has added?
Yeah, so I think from a European point of view, it's a bit of a mixed bag. I think if you look at the CAC, the French market, it's done quite well this year. The DAX and the UK market obviously under a bit of pressure. And as Nesan points out, there's a lot of uncertainty around Brexit. There's the Italian issue at the moment as well, which is also, causing a bit of, I suppose, in short-term negative sentiment. Yeah, but if you look what's happening in the US, you've got these half-line tech businesses, and valuations are quite high, and yet I'll suggest you're at the late stage of the economic cycle and possibly the market cycle as a result of that. When you come across to Europe and you touch on Unilever, Reckitt Benckiser, these are more of your, defensive businesses. They're not, their valuations aren't demanding. It's probably a bit of a contrarian view to go into the UK now. But, if you want, I suppose a more defensive element to your portfolio as opposed to these half-line US businesses, maybe some of these more boring, old-school European businesses might not be a bad place to be investing in.
Right, and sometimes old school isn't always very boring. I know previously on the show we've touched at emerging markets and pharmaceuticals, as well as consumable goods have also been a key area when it comes to the EM space. But should we still be looking at the EM space given the macroeconomic pressures on many of these economies, especially starting here at home in South Africa?
Yeah, I think you need to. I think you need to be very diversified right now.
Yeah.
Because yes, the tech companies are doing very well, but they are at very high valuations. So you just can't have a portfolio with, Apple, Amazon, Google, Facebook. If there's a correction in that market, then at a portfolio level, you're going to take serious pain. So I think you need to have a blend of local and offshore.
Is there a perfect balance though? Give us some
well,
kind of
this is what we all aspire to, right?
25% here, 30% there.
It's like life, you're always aspiring to that perfect balance, but it's a work in progress. And I think right now the blend that you have between local, offshore, and offshore, US and rest of the world really, is going to determine your portfolio returns and how well you blend that and how well you achieve that balance. Right now, the only concern that we have in South Africa is we're dealing in a very uncertain policy environment. We're not so sure where interest rates are going. We're not quite sure where government policy is going on, things like land reform, telecommunications. We're not sure where the growth is coming from. And historically, that's actually a good time, to take a dive in and to buy. But I'm still not sure whether we've seen the worst of it. I think we need some sort of, clarity as to where policy is going into and some of the implementation, before we can expect the next leg of growth.
Yeah.
I suppose if you think about, where, what drives investment returns at the end of the day, it's, corporate earnings in the long run. Short-term sentiment obviously has an impact in the shorter term, but long-term, it's your economic growth, which in turn drives, corporate profits, which in turn results in investment returns. So if you want, if you want those investment returns in the long run, you need to have exposure to emerging markets. And if you think about, global equity markets right now, 60%, if you take the MSCI World Index, for instance, 60% is the US. The US only contributes 24% of the global economy from an economic point of view. Emerging markets contribute 60%, and the growth is going to come from emerging markets going forward. This isn't to say now go and put all of your investments into emerging markets, but you want exposure. And you can get that exposure by investing in companies like a Nike, for instance, or a Starbucks or Walt Disney that get a lot of, or I suppose derive a lot of their earnings growth from these emerging markets. And I think that's the important point, that you need to ensure you've got that exposure.
And that's critical, the how, right, in getting that exposure. Because for the average Joe on the street, you think, right, just put your money in the JC All Share Index. But in the last 3 years, that hasn't proved to be very favorable, given the comparison to international markets. So given these dynamics in South Africa and the negative outlooks that you referred to earlier, Nesan, what do we do when it comes to SA-specific stocks, especially when it comes to banking and retail, which are probably the hardest hit when we have difficult macroeconomic conditions? Andrew?
Yeah, look, I suppose, as Nesan pointed out earlier, it's very depressed at the moment, and sentiment. It's funny how quickly it changes, and this year's a perfect example of it. At the beginning of this year, everything was great. These banking stocks, retailing stocks,
Ramaphosa.
Absolutely, and now we're in Rama reality, and suddenly we realize that things don't turn around as quickly as they do. But where it's the darkest, I think that's probably the best time to be investing. And I would almost suggest we pass the darkest. I think, the ship turns very, very slowly. It's not as we thought in the beginning of the year, suddenly all our problems are fixed. It takes, I think, many years to fix out the last decade of, what's happened. But as we know, markets are forward-looking. They will react before we actually feel it on the ground. Ramaphosa is making the right noises. It's going to take time, obviously. But I'd suggest that now, if you look at different sectors, property is a good one as well. Property valuations today, SA listed property, is at the valuations that they were at in the middle of the global financial crisis 10 years ago. So from a valuation point of view, the opportunities are there. It's whether you, I suppose, can stick to your knitting and invest when the sentiment's really negative.
Yeah. Nesan, Rama reality, how is it affecting your portfolio?
I think the benefit that we have is that valuations have come down. The challenge that we have is, are they going to come down even further? And right now, you mentioned banking stocks. I mean, apart from Capitec, the rest of the banks had very meager top-line growth. Nedbank had 20% growth, but it was largely because of EcoBank. It changed from last year, which is kind of like a once-off. But the banks have guided to a very weak economic environment, very weak lending environment. Banks need to lend money in order to make money. So we're not seeing that right now. And Capitec was a clear outlier, not from its lending book, but because it's growing a transactional business. So, there's pockets of good news across the various sectors. And I think what you need to do is identify those pockets and maybe try and see whether or not that can continue and make the investment there.
Yep, well, finding pockets of excellence and opportunity, understanding that diversification is very key, and of course, sticking to your knitting for the long term, but being nimble enough to adapt to the realities on the ground. Well, do stay with us. In just a moment, we will be unpacking some of those stocks that you need to consider and put into your portfolio, given our review of the macroeconomic conditions and some company updates we've seen of late. But in the meantime, do be sure to keep your emails coming and send them to portfoliowatch@abn360.com or tweet us at CNBC Africa using the hashtag #PortfolioWatch. We'll be back after this break. Welcome back to Portfolio Watch, where we're taking a look at the markets in general, as well as the performance that we've seen in quarterly and annual results from global and locally listed companies. My guests in studio today are Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nesan Nair, who's the Senior Portfolio Manager at Sasfin Securities. Now, just before the ad break, gentlemen, we really got a very clear synopsis of the very different stories that we're hearing regarding developed economies, what's happening in the US, emerging markets, and of course South Africa. But we're looking for those pockets of excellence, right, that exist both locally and internationally. And I'd like to start off with the first stock that I actually had exposure to this morning through breakfast by eating Wheat Bix, Pioneer Foods, right? Very SA focused in the consumer goods segment and managing to keep its head above water, it seems, if we do take a look at some of its recent results. Andrew?
Yeah, so the results, well, they've just come up with an update. So the results aren't out yet, but they're guiding for, much improved earnings growth in particular, I think up 24 to 34%, but you've got to look where they've come from. They've had a very, very tough time, partly due to some macro headwinds over the last couple of years, partly due to themselves. They had a hedge that worked against them for the procurement of maize, which obviously had a material impact on their input costs.
Sure.
But if you think about how quickly sentiment changes, Pioneer Foods not too long ago was one of the market darlings. Everyone loved it and it could do no wrong. Over the last couple of years, it's the complete opposite. So when it's had trading on earnings multiples of close to 30 times, now they're on a forward multiple of about 11 times. So that shows you how quickly the sentiment turns. The share price has been under immense pressure, and it's not just Pioneer Foods. You look at any of the food producers at the moment, Libstar, Rhodes, for instance, they're all under significant pressure. This is obviously a weak rand that impacts the input costs, high oil prices, a very competitive environment given weak consumer demand as well. So they can't push those prices through to the retailer or the consumer.
Are we buying Pioneer?
So it's I'd say it's a contrarian call at the moment. We do hold it at PCS. We've held it for some time, and we will continue to hold it. The valuations are incredibly attractive, but sentiment is very, very negative towards it at the moment.
Yeah. If we do take a look at another sector, though, completely different from where Pioneer Foods operates, Investec Property Fund. And as you alluded to, we've seen some interesting changes in the property dynamics in South Africa, a lot of which also leaning on corporate governance issues, right?
Yeah, so property's been under immense pressure this year as well. I think it's down about 25%, the property sector, listed property sector as a whole. Again, one of the market darlings, over the past 10 years, the best performing asset class. You couldn't have done any better than just investing in the SA listed property space. Investec Property Fund, we think, is one of the highest quality property portfolios. When you just look at their property, they've got a very nice mix between retail, industrial and office space. They've also got some offshore exposure. Investec Australia Property Fund, they own 20% of that property portfolio. And they've also got Investec Argo in the UK. So it's very diverse, but when you look at the valuations, it trades on a price to book or price to NAV of 0.85 times. In other words, a 15% discount to the value of its property on its balance sheet. Dividend yield of 9.5%, and they're growing their dividends. Their recent trading updates, their dividends will grow between 5 and 5.5%. At the next results. This is lower than what management guided for at the beginning of the year, but they're still growing, and yet you're getting a yield of close to 10%. I think it's a fantastic opportunity. But walk through any shopping centre at the moment, specifically not necessarily your big shopping centres, but you see there's plenty of space available. You see office space being advertised everywhere.
Yeah.
The property market in South Africa on the ground is incredibly tough at the moment.
So don't be fooled by all these cranes and a lot more headquarters moving into the Sandton district. But speaking of these headquarters moving into the centre of the Sandton CBD, financial services, Nesan. This is also quite a key one, provides us a good indicator as to how economies might be performing. But you're quite bullish on Capitec, which you touched on earlier before the break.
Yes, if you look at the big four banks, right, all of them had very similar results coming out. Weak top line growth because they're not lending. They managed to get some growth out of their what they call non-interest revenue, which is your bank charges and things, but certainly not enough to justify the increases that they've seen in costs. In Capitec's case, it's been a very different story. They've also got a big lending business, but it's not as big as what people think. What we're finding is that they were able to grow their transactional revenues by 32%, and that's because they're getting a lot more customers in. So it's not the market that's growing, it's just that existing clients of the big four banks are finding that Capitec's transactional services offering and products are just a lot more competitively priced and a lot more suitable to them. And in the current environment, where consumers are strapped, it makes a lot of sense, to look at what costs you can cut. And funnily enough, bank charges is one of those. It's just easy to operate Capitec bank accounts, a lot more cost effective. And so they were able to get clients from a lot of the other banks. And I think this innovation that we've seen in Capitec's offering is helping them get more clients in the environment. Headline earnings grew 20%, the dividend was up. And I think here you have a growing business in a non-growing market. And I think that's a testament to what great management that they have. And they've been doing this consistently for many years.
Now the market isn't growing, but it's certainly becoming a lot more competitive with Bank Zero, Discovery also said to enter into that particular segment, and many other players as well offering some banking services in South Africa. Discovery features on your list here. Yes,
and I think partly because of their innovation. They also came out with results. Headline earnings were up 16 or 17% at the time. And the businesses that they've incubated, the likes of Ping An, for example, the UK business, and Discovery Insure, which is their short-term property insurance business, all those businesses now coming into the forefront and starting to make profits. And we can see, Discovery's been a great incubator for many sort of innovations, if I can call them that, businesses that were able to disrupt existing markets in order to get grow their market share and grow their client base. And I think Discovery is one of those businesses in the insurance sector that has managed to do that. And they've been victims, like in the banking sector, they've been victims of Capitec, they've been victims of Discovery. We see the likes of MMI, for example, Liberty, old very established insurance businesses losing customers to the likes of Discovery. So I think as an investor, you need to ensure that your portfolio is orientated towards these growing companies.
Okay. And those are companies that we're familiar with and have some exposure to from a local point of view. But sticking with the offshore and diversification story, Nike is one of those that also presents some good investment opportunities. Now, when we think about them, we probably think about their recent marketing campaign, including Serena Williams, and of course some great sneakers. But other than that, from a numbers point of view, Andrew, does it all add up?
Yeah, so there's obviously a few negatives, from a marketing point of view, as you point out. But when you look at their numbers, so they just released their first quarter for their 2019 financial year, and the results, as expected, were very, very good. And this talks exactly to this theme of the US economy and how well it's doing. Plus, they've got quite a bit of exposure to emerging markets. So, about 15% of their revenue comes from China, and China grew revenue for Nike at about 20% over the last quarter. So there's, this is the exact theme that we're talking about when getting exposure to emerging markets. The issue with Nike would obviously be when you come to valuation, but this isn't just a Nike issue, this is, the broader US markets. I'd say it's probably fairly valued at these current levels, but they continue to buy back shares at a rapid pace. They're in the process of a $12 billion share buyback, and they've just announced a further $15 billion. If you put that in perspective, it's got a market cap of about 120, 130 billion. So it's a substantial portion of the shares outstanding that they're busy buying back. Now you've got to ask yourself the question, from a capital allocation point of view, are they buying back at the right time? At these, time will tell. We'll probably sit here in a year or two and look back and discuss that. But at the moment the going's very good. The share price, I think, is up about 60% over the past year. So it's, it's a company that is just riding this wave of, this positive economic growth that we've seen in the US, plus the exposure to emerging markets. Yeah.
When we talk global, though, it wouldn't be a portfolio watch or an investment show if we didn't touch on technology, right? And we so often talk about cloud services and storage of data in this imaginary space, but somewhere out there in the world, there have to be actual service. And this is where Equinix, right, comes into place, Nesan.
They're the biggest cloud server provider. So, whether you're using Google Cloud or Amazon Web Services or Microsoft Azure, when they say stuff gets stored in the cloud, it doesn't actually go to a cloud. It actually goes to an offsite location that you're not really aware of. And this offsite location typically is a server farm that's operated by Equinix. It's the largest server infrastructure provider in the world. And I think if you look at the technology results that have come out, all of them showed incredible increases in their cloud businesses. More and more customers obviously adopting the cloud in order to operate their servers and their applications, rather than making a big investment in sort of local service infrastructure, on-site service infrastructure. And I think also if you look at something like cybersecurity, the cloud is a lot more secure. Now, a few months ago, we saw the attack that was on Liberty. For example. I think IT strategists in companies are looking for ways in which they can actually outsource that responsibility to somebody, who's really equipped towards dealing with, providing that sort of firewalls and security, rather than them having to keep up to date with it all the time. That's another area where cloud is being able to get a lot of clients.
Yeah. So clearly making sure that you investigate some of the stories or companies that add to the background story of some stocks that we're exposed to. Gentlemen, a great time with you today on the show. Unfortunately, we're under pressure, but of course some interesting stocks that we've certainly delved into, the likes of Pioneer Foods, Investec Property Fund, Nike, and of course Capitec, as well as players like Discovery from a South African point of view. But always look at the research and of course consult professionals in your industry to be able to assist you with your investment choices. A big thank you though to two of my guests in studio today, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nesan Nair, who is a Senior Portfolio Manager at Sasfin Securities. A big thank you to you two for tuning in, and looking forward to some of your interaction on Twitter. So keep that feedback coming and share your suggestions with us by joining the conversation at CNBC Africa using the hashtag PortfolioWatch, or email us your questions and additional suggestions to portfoliowatch@abn360.com. Until next week, have a good one.